All right, class. So this is going to be going through those Excel problems. These are the Excel problems for Module 4. If you see here, the first problem, they give you a retention ratio, they tell you the net income, and they tell you the number of shares outstanding. If I want to calculate what the dividend per share is, if I'm retaining 60%, then I must be paying out 40. So I would say 1 minus the 60% according to that cell. And then I would multiply that by the net income. And that would tell me what's the total amount being paid in dividends. Then when I divide that by the number of shares outstanding, that gives me the dividend per share. For the second problem, they tell us what the beginning and the ending dividend is, and then what the time period in years is between the start and the end. So when we're trying to calculate what this rate of change is, we would use the rate function. The rate function calls for n, the number of periods first, which is this 12. It then calls for the payment. Now we have no intervening payment in the sense that we're just looking from the beginning to the end dividend. So you can put in a 0, they just put 2 commas, so it's assumed to be 0 between. Then we have to put in the present value and the future value, or the first year and the last year. The present value, you notice, is put in as negative. That is because one of these must be negative and the other must be positive for the calculation to work properly. Once all of those pieces of data are in, it'll then solve for the R, which would make this true. For the third problem, we have a dividend paid at time 0. We know that it's growing at this non-constant rate for the next 3 years. It will then level off to a constant growth rate, and our discount rate over all of this time is listed there. Okay, so to calculate our dividend, we start with our initial dividend and multiply it times 1 plus the growth rate. And the growth rate we're going to use is that non-constant for the first 3 years. For the other years of growth, what we're going to do is use an if-then statement. So you'll put in equals if, comma, or equals if parenthesis, and then we start entering the data. So the first thing is, what are we checking? What we're going to check is whatever is in this column for the time number of years. And we're going to see, is that less than or equal to the 3 here? If so, then we're going to multiply the previous dividend times this non-constant 1 plus the non-constant growth rate. If that is not true, then it means we're in years 4 and further, and then the false is multiplying the previous dividend times 1 plus the constant growth rate. So it's going to do these checks for each of those, and it's going to multiply it by the appropriate growth rate. Now, once we've completed that, the value at time 5, we know that if we have the dividend at time 6, we can calculate the value at time 5 by doing the div 1 divided by R minus G. In this case, the div 1 would be the time period 6 because we're calculating the value at time 5. And then the R minus G would be our discount rate minus what our constant growth rate is. And that gives us a value of the stock at time 5. And then the value today is just the net present value of these future cash flows. So we're discounting all of this back at our discount rate of 11%. That's the first thing that we enter. And then for the rest of these, it'll be time 1, time 2, time 3, time 4. And then time 5, we have 2 cash flows. We have both the dividend and the value of the stock going forward. So we'll just add those together. The value today is found through that NPV formula. Okay. And that is all for chapter 18 of module 4. For chapter 19, problem 1, we're given a large tax table, and we're told that we have $315,000 in taxable income to do our calculations with. Okay, so the question is, what is the tax on the base income of that bracket? So we need to figure out which bracket this goes into. And the function we're going to use is this VLOOKUP, this vertical lookup, meaning I'm going to search through a particular column for a value to see if it's true. Okay, so the value I'm going to search for is this taxable income piece. And I'm searching for the taxable income within this taxable income bracket. The thing that I'm going to want to return is the tax. So I'm going to need this third column here. So when I do my search, I'll say I'm looking for D7. I'm searching between C11 and E18. I don't just use the one row because I want to return a value in another row. Right, so I'm going to have to highlight all of those, and I'm going to say what I'm looking for is found in the third row. Right, and then I'm going to put in true, saying this is what I want it to find this value, not approximate. Okay, and then the tax on the income within the final bracket is I'm going to do that same type of lookup. I'm going to return this fourth value. So you see here where I'm going through C11 to F18, right? So I'm going to include that percentage piece. And then that's what I'm going to return is this percentage, right? For the column in which 315,000 falls. Okay. So once I get that amount returned, then I'm going to say multiply that by the 315 minus what I've already paid taxes on. Right. And so it's going to be the D7 minus what I found in that first column. Right. So it's obviously has to be less than the 335. That'll be the 315 minus this amount, and I'm multiplying it by that percentage. And so I am paying 22,000 on the first 100,000. I am paying 83,000 between that $100,001 to the $315,000. When I add those up, and I just do that here, that tells me what the total tax I paid was. My average tax will be total tax divided by taxable income, and the marginal tax again is just a lookup trying to find where my taxable income falls, and then what is the fourth column here that will show what my percentage is. With problem 2, we're going to calculate net income. So they tell me what the ROE, rate return on equity. They tell me what the debt ratio is. They tell me what my annual sales is for this period. And they tell me what my capital intensity ratio is, which is a ratio between assets and sales. So when I'm trying to calculate my total assets, it's simply going to be the capital intensity ratio times the sales. When you're asking what is the total debt going to be, I know what the debt ratio is, and I know what the total assets is. So total assets times the debt ratio will give total debt. Total equity is going to be equal to assets minus debt. If you think of the balance sheet, the assets are on one side, debt and equity is on the other. They must be equal, right? So that's how we know that's true. And then the net income, I'll start with what my return on equity is, and then I can multiply that by my total equity, and that'll tell me what my total return is, which is net income. Because net income divided by equity, by definition, is return on equity. And then for our third problem in these homeworks, they lay out this company with a story here, but they tell us what the sales last year was, let me scroll down so we can see this easier. Okay, so they tell me what the sales last year was. They tell me what my profit margin is. They tell me what my retention ratio, or what percentage of the net income I retain versus pay out as a dividend. They tell me what sales will be next year. So I have last year and next year's sales. They tell me what my total assets are. They tell me what my current liabilities are. Okay. So if everything is remaining the same and my sales are changing, my assets are going to change to match those sales. My sales are declining. That means my assets will also decline. Okay. So the way I calculate what this will be is I'll say, well, I know what my previous assets over the sales was, that ratio. So I can say assets divided by sales. And then I'm going to multiply that by whatever this change in sales is. So the change in sales is the new sales figure minus the old sales figure. Right now, this is a smaller number than that one. So this whole bit within the parenthesis is going to be a negative number. And that's why down here, I also get a negative number. Okay, just as my assets proportionately changed, my liabilities are going to proportionately change. So I'm going to take current liabilities divided by what the sales were, right? Because it was current at the time of these sales, right? So current divided by sales. And then I'm going to multiply that by what this change in sales was again. Again, it's negative. So my spontaneous increase in liabilities is negative. So basically, because sales are decreasing, we would assume that I'm selling off assets, and then I'm also reducing the amount of liabilities that I'm holding. Okay, so what does this mean for retained earnings? Now, retained earnings is not going to be negative because retained earnings is based on my new sales, right? So I'm going to have sales. Those sales I'm going to, in fact, I'll show you this formula here. So I'm going to take the sales, I multiply that by my profit margin. That's going to tell me what my net income is. I'm going to multiply that by my retention ratio, and that's going to tell me how much I kept within the firm, right? So I brought in this 8.2 million, right? But since only 30% of that was net income, the rest of it was me paying for all my operations and such. And then only 20% of that I kept, the other 80% I paid out in dividends. But what that means is I'm going to bring into the firm $492,000, or retain within the firm. I'm sorry, let me restate that. I'm going to retain within the firm $492,000. Okay, so given that my assets are going down, my liabilities are going down, and I retain earnings, you know, what's my initial funds needed? This is going to be like funds released, basically, in our case, because it's negative. But what that's going to be is we simply say, okay, how much do I have to pay for assets? And then minus whatever my increase in liabilities to offset that. So I'm going to increase in some sort of short-term debt, right? This is current liabilities. But in this case, they're both negative numbers, right? But I would just say, what's my assets minus those liabilities, and then minus the retained earnings, right? Now, if you think about it again, it's on a balance sheet. The assets are on one side, liabilities, retained earnings are on the other. So I start with assets minus whatever change in liabilities, retained earnings. That difference is what I need to balance, right? And so that's what you're seeing here. This one is just a little confusing or not quite intuitive, because we have this decrease in sales, which is leading to a decrease in assets, decrease in liabilities. Often when you think of this, the company is growing in sales, so I need to buy new equipment. I'm also incurring new liabilities as part of that, right? So, but this is just for us to think about making those capital decisions, right? These are not made to be tricky. The point of it was really more for you to become a little more familiar with doing the formulas in Excel. So, thank you.